Welcome to The Gray Report. I'm your host, Spencer Gray, and every week on The Gray Report, we break down the latest research reports, data, articles, and opinions, all revolving around the multifamily industry, commercial real estate, housing, and the macro economy. We've got a CPI print that just came out, and a lot of questions about housing. It's incredibly important. It makes over about a third of that inflation component, and there's a lot of debate of what's real and what's not real. Also, Yardi Matrix just released their winter U.S. multifamily outlook for 2026. A lot of interesting insights. We want to break into some of these details and what they're calling out, not just for 2026, but 2027, and even some predictions for 2028. Haven't seen those long-running forecasts in a while. And then the John Burns Research and Consulting and CRE Daily Research, their Fear and Greed Index report. Going to jump into that as well. See the changes from their last release, and we're identifying some shifts. Maybe not major moves, but some shifts in the psyche of commercial real estate investors, and they are putting the buy signals on, even amidst all of this uncertainty. Nobody knows what next year is going to look like, but we are here to try to figure it out all together. All right, stick around for this full episode. Make sure you like this video if you think it's decent enough, and subscribe to the Gray Capital YouTube channel so you can get notified of all these hard-hitting multifamily episodes. Stick around. Let's get into it. All right, welcome back to The Gray Report, joined by co-host Griffin Haddad. Griffin, exciting week. It's New Year's. It's a holiday season, but we don't rest because the economy is moving and people are trying to make deals. And we've been running around here trying to find new multifamily acquisition opportunities. The market's not participating, but fortunately the data doesn't stop. And at least it's continuing in terms of the CPI. We had an exciting webinar last week. We went into our 2026 Midwest multifamily forecast. Huge success. A lot of folks attended, answered a lot of questions. It's posted on our YouTube channel. I'd like folks take a look at it. We're getting into some other forecasts today. Yardi's got some predictions in here. A lot of interesting hot takes. We've been putting a lot of it together. We've been assembling the Gray Report newsletter every single week. I'm going to ask you just what's on the tip of your tongue in terms of the movements in the multifamily industry that's going on right now as we exit 2025, as we get into 2026?
Right. Another trip around the sun.
Yeah.
Investors, specifically in the multifamily space, attempting to be patient, attempting to be disciplined. Opportunities for acquisitions seem to be few or far between, but are ticking up. And I think if you are a capital allocator, the number one priority right now is investing with a prudent sponsor, somebody that you can trust to not only just do a deal to do a deal, but somebody that has the operational capacity, the bandwidth to underwrite the projects with a discipline, as well as the relationships to operate that asset for its hold period. In all of the forecasts that I've been looking at and all of the articles and information that I've been digesting, the growth across the multifamily sector is experiencing what I would say is a pretty significant deceleration. Here in the Midwest, we're also experiencing that, but it seems to be maybe a little bit less prominent than the rest of the nation. Amongst some of this deceleration and growth, the operational side is focused on reducing expenses and maintaining occupancy, while in the capital allocator space, it's really solving for cash flow. So we talked a little bit about that in the previous podcast, or actually, you know what? It was the webinar. We had a great question on the YouTube about what investors should be searching for in 2026. You and I both agreed that patient capital focused on cash flow should be everyone's number one priority, at least in the multifamily sector. So to kind of summarize, just maintaining a disciplined patience with a focus on operational cash flow really in that first year.
I think that makes a lot of sense. If you can't speculate on future growth, you buy something that's cash flowing today, it's always going to be you can't always say a sure thing, but it makes a
Right.
lot of sense. Very prudent decision. Well, what's got you excited? I know you look at a lot of different type of stuff. I mean, I don't know whether it's multifamily, other real estate. I mean, I know you're talking about cryptocurrency, and I know we're deviating from the plan, but just curious what Griffin, what you're thinking about. What's piquing your interest right now? Every single week, you're assembling the newsletter. You're looking at a lot of different asset classes and things moving.
Yeah. We go to these events across the country, and we went to one in Miami. It was probably a month ago now.
Yeah.
And there are so many different ways that you can invest capital, put money to work. It's a really exciting time as we continue to digest information on, real assets, and specifically multifamily. There's a lot of eyes on the supply cliff, the supply kind of pullback. There's a lot of eyes on rent growth going negative across the nation.
Yeah.
But my most exciting thing that I'm looking forward to, really, I think, just as we end 2025 and jump into a new year, is how Great Capital is positioned in the Midwest as a leading owner operator.
Oh, Griffin, you're too nice.
Right.
Okay, you're selling Great Capital.
Well-
I appreciate that, but no, I'm just curious. What do you think? What's exciting? What else are you looking at?
For
apartments?
my personal
I like
year,
apartments too. Me too. But what else?
I'm a big golfer.
Yeah, okay, there we go.
A lot of development going on in the golf space, whether it's first generation or second generation golf courses that are getting developed. Really in the Sun Belt, South Carolina, there's a town called Aiken, South Carolina, that just is booming in the golf course development space. Got the privilege to go down there, would have been a year ago, almost today, to experience the 2 of the golf courses down there, but there's many more getting built. So it's a sign of the times where the economy seems to kind of be churning. Capital is flowing into golf development, and as a golfer myself, I get the privilege of reaping the benefit of getting to enjoy these golf courses.
Awesome.
That's what I'm excited about.
So are you a golf? And I know your family's a little bit in the business, but are you a golf course investor? If you saw a new golf course development, is that attractive? And what other than maybe some of the growth in the sport, what's attractive? Other than that, you're a great golfer and it's a great sport. Just from an investment standpoint,
the golf business probably is not a great investment.
Okay.
Unless you
a passion play. Then
it is a passion play. It is a low return on your capital in regards to cash flow across the operational period. The big kind of money mover there is the growth in the overall project. If you can grab a rundown, municipal golf course, forgotten golf course, turn it into something special, and then offload it. Now that's challenging because if you do that, you're essentially offloading a lot of time, energy, sweat, effort, tears,
so you're
blood
going the value add
to somebody
strategy,
else.
or maybe even opportunistic, turning it around.
Right, and so there's actually a lot of, in the golf course space, there's a lot of golf courses that are getting sold off for residential development.
Yeah.
And as a golfer, it's a little bit dissatisfying because
Yeah.
you're watching a great golf course go to what is, kind of a 0 lot line neighborhood. So if it's up to me and I had the capital to do it, I'd go buy every single one of those golf courses and try to find a strategic way to turn it into more of a cultural center for that community. There's all sorts of this going on where it's not just this 18-hole championship-style golf course, but they're building par threes, they're building putting courses, and they'll put covered patios where they have rotating food trucks, different musical sets. You can bring your dogs, different things like that to get people that don't otherwise or do not maybe have access to golf, or the barriers to entry of golf are so high, they're breaking them down, inviting you out to the property for other reasons, getting a golf club in your hand and making you feel welcome. That's kind of the direction
Our
which
golf courses, and then not to talk about golf all episode, but there's probably some folks that watch and listen to the Great Report that are interested.
Yeah.
Are golf courses bringing in, I guess, maybe like other activities to bring maybe non-golfers or folks that don't just golf in and to participate a little bit more? Because I hear what you're saying, especially if you're very passionate about golf. From the other perspective, though, it's a lot of land that's used for like one particular like sporting activity. Like if we're going to take so many acres for like frisbee golf or like for fishing or like hunting, which I guess there's a bunch of public land that you can go use with hundreds of thousands of acres. Or like we're gonna take 50 acres for pickleball. People be like, okay, how many pickleball fields do we need? Do we need a couple dozen in a city?
Sure.
So I say all that, but I guess how are we bringing the non-golfers in to I guess participate in that experience? Maybe just to give them a little taste of golf, or
Right. No, you're hitting the nail on the head. The resort style golf. There's a few places I have in mind. Don't need to name them, but if you travel destination style golf, public access resorts, you can go Play tennis, pickleball, archery, fishing, hunting, 5-stand shooting, clays, different things that get folks on property. And really it's tailored towards maybe folks that want to come out and play one round of golf. You can bring a corporate event out there where if you do or do not play golf, you can choose, hey, I want to play one round of golf, and the next few days I'm going to go fishing and go hunting. I'm going to go shoot guns, and I'm going to go fishing. And then they typically will have several restaurants on site, and the food is always, very top class, upper tier. So they are drawing in, different walks of life to the golf centered business. But I will say in golf, there's a lot of acreage. We use a lot of water in the sport, but the best golf courses are these old ones. There's one down in Aiken I just spoke about in Palmetto. They had 97 acres, and they built this amazing 18-hole championship routing, and it stands the test of time. But then you get these new developments. They're buying hundreds of acres, 5, 6, 7, 800 acres, 900 acres or more, and there's still only 18 holes. And so you have all of this kind of dead space that gets utilized.
Do you have to kind of do you have to travel to drive the golf cart through the over the river through the woods?
It just depends on how the golf course architect wanted you to experience the property.
You have to hike.
I prefer a short
over a mountain to get there.
There's a course out in Oregon called Bandon Trails that they call it a tee to green distance. So how far, or green to tee, how far does it take you to get from the one green to the next tee?
Yeah.
I prefer a shorter distance because I like to walk. But there are golf courses that have long tee to green distances or green to tee distances that people will take golf carts in. Those golf courses typically won't let you walk. So those are not my favorite, but
fascinating.
Those are out there. I could talk about golf all day.
Well, it's a really interesting topic, and I think a lot of people appreciate it. And if you want to talk more about golf with Griffin, you know where to reach him.
Go play.
GreatCapitalLLC.com. You're going to find yourself scheduling an investment meeting with Griffin, but hey, it's up to you to use that time, and it's up to Griffin to stay on topic maybe about multifamily or golf. Let's see. Okay. Q4 2025 Fear and Greed Survey from John Burns Research and Consulting and CRE Daily, sponsored by InvestNext. Well, that's a lot of for a lot of groups put this great report together, but I think they do a really good job over at John Burns Research and Consulting, as well as the CRE Daily. I'm a fan of both. Kind of the big news is of the index. Out of 100, it's at 58. Which means we're expanding and things are trending in a positive direction. Now, this is a survey that is comprised of industry professionals, owners. I think 32% from owners, and you have general partners, some operators. So it's a lot of decision makers that are deciding whether they're going to invest more or less into commercial real estate. A lot of multifamily folks, but they've kind of balanced it out for a variety of asset classes, including industrial, retail, office, and other. And it's really from across the country. Really a pretty even response rate from different states and different regions. So a pretty good kind of assessment of kind of the state of the market according to investors. And so what we've seen here is definitely a tick up in terms of the towards the greed corner, which would be absolute greed would be 100, and fear would be 0. I think this survey is only about a year and a half old, so they don't have that much data. Right now, they're looking back at basically Q1 of 2024. But so it's going to be more useful as time goes on, as we get through multiple cycles. But the biggest change that I saw here is the access to CRE Capital Index moving from in the third quarter of 2025 to 43, which was a jump up from 39 in the second quarter, all the way up positive to 52. And so basically this shift is essentially saying that last quarter, people thought it was challenging to raise capital for commercial real estate. During the fourth quarter, that shifted. More people are saying it's easier to raise capital than it was. The capital is available. Investors are starting to get off the sideline. Griffin, does that line up with with the conversations that you are having, have had, and we had a successful fundraise in the fourth quarter. Well, ended in the fourth quarter.
Yeah, it did.
For Flats and Stones Crossing, our latest multifamily investment that we raised capital from accredited investors. We were surprised with the amount of family office demand and retail demand, less institutional. Does this line up with what we saw, or just curious your thoughts? some of these levels?
Yeah, I think first and foremost, it's obviously it's a great thing to see as we go out and fundraise for deals in 2026. It's the largest uptick on any of those graphs in regards to magnitude, and so it really does depict, I think, what we were seeing across a lot of our fundraising as we entered into Q4, and then again as we traveled to some of these events for truly networking and capital raising purposes, where in the front half of the year, even in Q3, we would go to these events and people are kind of steady and comfortably positioned on the sidelines, waiting and trying to be as patient as they could for the right operator, the right deal. It seems more and more now as we talk to investors, whether it's here at Great Capital in regards to a retail investor or a family office, they're always looking for ways to invest their money, but there wasn't a lot of action being taken. It seemed like people were kind of circling the wagons and window shopping. I think that there's a lot more trigger pullers out there currently, people that are actually writing checks, and I think that gives me, at least personally, a lot of encouragement and enthusiasm as we see transaction volumes pick up. We're talking to here Jay in the office about all of the opportunity that may present itself in 26. It's also good to see people are willing and looking forward to or more encouraged to write checks. So let's hope that the opportunities present themselves.
I was going to say that's the key, is the opportunity, because I would agree with you. A lot of investors are ready to go, ready to write the check. They've got the checkbook out and they're ready for the next deal. Mm-hmm. But there's not the next deal. And even if you really dig around and you ask, we've ramped up our direct outreach to owners, sending letters, direct mail, like not just emails, but we are snail mailing every single owner in the regions that we're targeting, trying to just shake anything loose.
Yeah.
And we don't typically do that because a lot of our deals are larger, more institutional size deals that almost always go through a broker, but with an absence of deals, we have to try everything to try to find an opportunity. Mm-hmm. But it's frustrating to have potential capital lined up.
Right.
Which does not last forever, but there's no deals to place it in.
Correct. That, or, you're in the midst of cultivating a relationship or maybe a first-time investment from a large institutional allocator, a programmatic partner. You've gotten to the point where they just want to see a live deal.
They want to see something.
To be able to talk through it, see how we see the market, see how we see the asset, kind of poke holes in it and see how we respond. Even when we get a deal that doesn't pencil, it's super challenging to send that over because we simply don't have any confidence in going after it. So why would we go through that exercise in futility?
Yeah, here's a deal that we don't think looks that great. Right. Here, spend your time on it.
We want to talk about that with you. It makes no sense. So it is tough to continue to cultivate those relationships when there's not actionable deals, really coming across our desk, or few and far between at least.
Yeah, a little bit more confidence in the retail sector compared to any of the other commercial real estate asset classes. Industrial is also looking pretty good. Multifamily is falling a little bit behind, but really just, again, multifamily out of the whole index, 59, industrial is 60, retail is 61, so all pretty close. Office, not surprisingly, really lagging. Mm-hmm. But it is above 50%, or above the 50 mark. So it's at 53. So there is a little bit of a bid for office. I think there's a lot of folks that are just really curious and they want to buy office or curious about office because it's the one asset class that you can get a meaningful discount in. Like we talk about, I'd hate to buy office, but if it cash flows when it's 40% occupied or 50% occupied, that's starting to sound like a really interesting deal because maybe I get it to 60% occupancy, 70%, and then I've got a lot of cash flow. And if there's ever cap rate compression, you could be really sitting on a winner. This was an interesting one, and I don't necessarily say I disagree, although I think it's a pretty noisy environment, and these are surveys. According to the survey, investors indicate that multifamily and office asset values fell year over year. Not saying it fell by a lot, but by a little bit. Basically, it's been declining by about 6% a quarter in multifamily for the last several quarters. Mm-hmm. The industrial has been flat with a little 2% lift in Q4 of this year. Retail, mostly positive, 1 to 2% lifts every single quarter. Office, really bad. Negative 31% back in Q4 of 23, but not nearly as bad as it was. It's had a steady kind of like increase of
Right.
Less negative, -5% value change year over year on office. That's good. I mean, again, after falling, I mean, that's some. I mean, again, these are quarterly opinions of year over year changes, so it's not like these percentage points compound completely, but still, that's a lot of decline in at least perceived value. Let's move on. There's an idea that values may fall a little bit more in multifamily in the first half of 2026. That tracks for two metrics that I'm thinking about. One, we've got slow rent growth. We're going to keep talking about that. That's related to huge oversupply. We've delivered more apartments than we've delivered in 40 years. You know, looking at the Yardi Matrix report that we're going to talk about in a second, there's still 500,000 units in active lease up. 500,000 units. Prior to the pandemic, we were delivering like 300-some thousand units a year. We still have 500,000 that we're actively leasing up. So this narrative that, you know, supply is falling or has fallen off a cliff, it just really doesn't kind of match up to the reality. And we've got some more data on that. Again, it's not all bad news. It's just that it's not you're going to flip the switch and you go from -1% rent growth to 5% rent growth. It's just not going to happen, at least on a national basis with any kind of business plan. Yeah, so I mean, we did tick up. I think this was, you know, for the overall, you know, everybody's ticking up above 50, which is good. And people are generally optimistic about commercial real estate. If we go back here to whether folks are going to increase or decrease their exposure to commercial real estate, I don't think it's an exact analogy of like buy, hold, sell analysis, but
Sure.
I think it's the closest thing that we have to it. And basically, 91% of the market is saying they're either going to hold or they're going to increase exposure.
Right.
Only 25% in Q4 are saying absolutely we're looking to increase exposure. 64% are saying we're going to hold. I'm not going to change my exposure. But there's only 11% that are saying I'm going to sell. Now maybe they're saying that because it's just a bad time to sell, and they want to sell. They got to wait to sell, but they're not planning on it happening anytime soon.
I appreciate the quotes there on the right side. Just the kind of an insight as to, you know, it's obviously only two perspectives, but the cost of capital and debt kind of still eating away at the interest to increase exposure, but also just, you know, the individual that had that quote there in the yellow, the overbuilt in his area, and it's interesting as we talk about the supply that we're still having to manage and kind of deal with. Obviously, this is asset class agnostic, but here in the Midwest, you know, many of our markets are just simply not overbuilt, and so we don't have that challenge, or at least at the level upon which other markets do.
And it's interesting, again, the Yardi report gets into more of the actual numbers and the reality, but the markets that are currently oversupplied still have more supply coming. It's not like those markets have seen the sharpest declines in starts and construction activity. They're seeing declines from their peak, but it's still well above other parts of the market. Whereas like the Northeast or the Midwest, which saw the least amount of new supply, still records relative to their own history. But, you know, that's where the supply really has been coming off. You know, when I look at, you know, again, Indianapolis, for example, I mean, we think we were peaking out around 6% new inventory relative to existing. Markets in the Sun Belt were anywhere between 8 and 12. Right. Now we're down to like, I think 1%, you know, for next 2026. But you have other markets in the Sun Belt that are experiencing negative rent growth, like Austin or Atlanta, and they're still going to be delivering kind of 4 to 5% of existing inventory. And so, you know, what this next quote, it's that, you know, we're in a stagnant market, and I expect no major changes for the next few years. I mean, it's not, we're outside of this survive until 2025.
Yeah.
And all will be good.
Right.
Because everyone's realizing we're in 2025 and we're looking at multiple more years of more of this. Again, it may not be the exact same, but there's not going to be this inflection point that flips the script of the market and the economy, whether that's through a ton of distress or...
Right, you're not going to wake up one day and see a headline that's going to change the script of commercial real estate. If you're expecting that, you're going to be waiting a long, long time.
Exactly. Here's this chart I was looking for earlier.
Right.
The access to capital. We mentioned this earlier, but again, just I think having it visualized like this, I think does resonate with me in our conversations of where, again, the first quarter of 2024 was much more difficult to raise capital for than, and throughout 2025 and certainly near the end of 2025.
Yeah.
We were kind of really still in the middle of it. No one wanted to do anything. We knew that all this supply was being delivered. The rents really were slowing down, but also inflation was still really high. I mean, we had the 10-year Treasury that was getting close to 5% during periods of 2024. And all of that has, not absolutely reversed, but it certainly has been moving in a more positive direction.
Fun chart to cross-reference with the pace of just interest rate changes, whether it's cuts or increases, just to see, I'm hoping it would be an inverse relationship. However, we were raising capital across this entire timeline. And so it's kind of interesting to take a look at that purple line in regards to Gray Capital's exclusive multifamily focus and just kind of plot our assets along this timeline and some of the headwinds in the capital raise process that we faced relative to the results of this survey.
All right, Griffin, I want to jump to this Yardi report. It's their U.S. multifamily outlook for the winter of 2026. We cover these Yardi reports high frequency here on the Gray Report. This is a little bit different because it's a little bit more forecasting than just historicals. And I really marked it up because I thought there were a lot of interesting insights. And I don't want to just read all of my notes here, but there's a lot to talk about. Weak performance in 2025, and the expectation is we're going to have weak performance going into 2026. Same thing that our report is putting out there. I think the big question is kind of, when things might just start to turn around. I think some folks are putting that in like the latter half of 2026. Some other folks are putting it really closer to maybe 2027, mid 2027. Yardi, really kind of puts it, a little bit further out, closer to 2027 than 2026. They are forecasting rent growth of around 1.2% for national rent growth. That's a little bit above what we forecasted in our national rent report of about 0.89% national rent growth. We'll see who comes out a little bit closer to being accurate. I kind of hope Yardi does.
It's good to see some optimism.
It is
coming out of somebody so reputable.
And I would say if you're ever questioning, I guess our intentions. I feel like I'm speaking to my father-in-law 30 years ago, but speaking about our intentions of putting out research reports. Yardi has much more aggressive assumptions for our target markets than we do. So
they've got Indianapolis in here on the podium.
In talk we can basically the top four potential markets for rent growth. Almost all of them are in the Midwest, and as you mentioned, they're projected to grow a little bit higher than what we were projecting. According to the Matrix forecast, so Boston and DC are actually projected to lead rent growth. Those are prime examples of primary markets, big markets. Also, a good amount of regulatory burdens. At 2.1% year-over-year rent growth is a projection, followed by Indianapolis and Kansas City, both at 1.9%. Then Columbus and Detroit, both at 1.7%. On the other side of the spectrum, some of the largest rent declines are going to be in some of those same markets, including Austin, Charlotte, and Phoenix. And I do also like they put some of the cumulative rent declines and rent gains over the last several years. Some of the biggest decliners since January 2023, again, Austin, negative 12%, Phoenix, negative 5.7%, Pensacola, negative 5.3%, Dallas, negative 4.4%, and Tampa, negative 1.5%, with the strongest have been Twin Cities, 23.6%. Now, if you included through 2020, Twin Cities would be knocked off that list, just FYI. The Kansas City at 16.8, Chicago at 14.8, Indy at 13.4, and Grand Rapids at 12.4. So a big contrasting difference comparing the Midwest to the Sun Belt. And then getting into some of these deliveries, as we've mentioned, we're going to see deliveries slowing in many markets, but still going to be at elevated levels in others. Again, Orlando is still going to be delivering in 2026 4.1% of its existing inventory. Dallas is going to be delivering 3%. Phoenix 4.8%. Charlotte.
Charlotte. Yeah.
Charlotte's going to be delivering 6.4%. Going to be delivering around 16,000 units. That's compared to markets such as Kansas City, that's going to be delivering 2%. Columbus, Ohio, delivering 3.3%. In Indianapolis, delivering 1.1% or 2,300 units. Overall, much healthier supply levels that we would expect to normalize those markets a little bit quicker than some of those Sunbelt markets, which are most likely going to see just kind of over the next couple of years rent growth just being drug down.
You said it in our kind of pre-show conversations, pre-podcast conversations. This report's indicative throughout each paragraph of continued Midwest leadership. I think you used the word dominance. I'm going to use the word leadership in the multifamily sector. It's encouraging to us at Gray Capital. I'm curious as to operators that are in some of these markets in the Sun Belt, how they're viewing this report. Are they kind of scurrying in 26 to amend and kind of redirect investment strategies, or do you think they stick to their guns?
I think they're going to stick to their guns because I don't think they have much of a choice. I think they're going to point to supply coming down, relative to 2023 supply, but are going to maybe downplay that there's still a good amount of deliveries that are taking place. They're also going to be highlighting the really strong demand. Demand is incredibly robust throughout the Sun Belt. That's the reason why all these properties were built there.
Right.
It's because of the strong demand, good population growth. There are questions on the impact of immigration, the overall multifamily industry, its impact of population growth, less immigration, less population growth, less pressure on rent, especially in the bottom half of like the spectrum, but it affects the entire industry. So you have maybe a little bit more immigration pressure in the Sun Belt. And so if immigration levels have receded a little bit, you have a little bit less pressure. But a lot of the, the growth story from the Sun Belt, not just immigration, it's everyone from everywhere is migrating to the Sun Belt for affordability, quality of life, the weather.
Right.
Us in the Midwest, we understand that right now because it's really cold. But the affordability, that's starting to lose some traction in the Sun Belt as everyone from California moves to the Sun Belt. Well, the Californians.
Yeah.
Wherever they are now, and the prices go up, and that's leading the Midwest to appear a little bit more affordable.
Yeah.
It is fascinating. Griffin, you were talking about this before the episode, that even with all the, we're looking at the metrics, and there's going to be slow rent growth in the Sun Belt. A lot of apartments are still going to be built there. That's where investors are still continuing to choose. They're doubling down. In the report from Yardi, investors continue to favor growing Sunbelt in secondary markets per matrix. The volume was highest in Phoenix and Dallas, in Seattle and Miami, and Atlanta. But then saying liquidity is still present in primary markets like Chicago and Boston. You were just asking this question earlier. Are operators changing their strategy, or are they going to kind of shift? And investors clearly aren't changing their strategy. I think that they've drunk the Kool-Aid, and I've heard the saying that if you've made your mind's made up on something with one piece of information, it needs to hear the reality or alternative facts 10 times over before they're open to changing their mind again. And I think that's the case with the Sun Belt, where I'm committed to that thesis of investing in population growth and demographic shifts to southern states. Makes a lot of sense. The next step is that can be true, but relative to supply, it may not be the best investment thesis over the medium term. Long term, I think it makes a lot of sense. You pick up an A-class property in Austin, Dallas, Charlotte, you buy it at a decent price that can cash flow, I think you're going to be in a really good spot. I think the piece there is cash flow. And with negative rent growth, it's harder to underwrite strong cash flow in future years. Mm-hmm. So where all this is going, I think, lines up with the John Burns Research and Consulting CRE Daily Feed and Greed survey, talking about potentially lower prices in the early parts of 2026. It also lines up with our forecasts and some of our call-outs, is that there's going to be some attractive entry points. And because we can't project a lot of rent, so we can't get aggressive on pricing.
Right.
So that's going to not necessarily bring prices down. It could in some markets, probably should in a few, but if anything, it's going to act as like a ceiling on price. It's going to limit how aggressive folks can be. And so if you're an investor that's medium and a long-term holder, you can get in at a good entry point, pay for, zero to low rent growth in 2026, but then reap the gains of positive rent growth in subsequent years. And you don't have to know if it's going to come in the latter half of 2026 or in 2027 or by 2028, which Yardi Matrix expects, rent growth to get up to closer to around like 3.8%.
Yeah.
And I think that's one of the biggest call-outs, or one of the interesting pieces that I saw in this report, is that they are projecting rent growth to get up to almost 4%, over time. Mm-hmm. I think the question is, again, is that 1 year, 2 years, 3 years until we get to that level of rent growth? And every market, it's going to be a little bit different. But the key here, as we've said time and time again, is buy for cash flow and buy with a medium to long-term hold horizon, and you're not going to be in a bad spot.
Right. Be just curious, and maybe this is a great time to shout out a kind of a desire for different perspectives on the Gray Report podcast of different operators in different regions of the country. How are you guys underwriting new acquisitions relative to rent growth? I'm just thinking here at Gray Capital, we're somewhere between 5 to 7% vacancy in some of these oversupplied or more saturated markets. What does that look like? Do you think operators are underwriting, vacancies larger than 7%?
I think that they're assuming that things are going to recover sooner than they actually will. I mean,
it just seems like when we did the report last week, we also forecasted vacancies in some of these markets where we have these 500,000 units that are still in lease up, and those are some outliers in the data, but vacancy rates are continually kind of expanding across the U.S. And would just be curious as to what an underwriting model looks like with negative or flat rent growth year over year
what's tough is
vacancies.
The challenging part about it is, let's say we're bottoming out, which you can only have so much confidence in. I think that given supply levels, I think we're close to the bottom of occupancy or the peak of vacancy, however you want to describe that. Apartment lists, the vacancy is at its highest level since 2017, which doesn't go back that far, but still, vacancy is really high. And so it would be reasonable, if we're at the peak in vacancy, to assume that vacancy will improve over time. But that's challenging to go to investor and to improve those assumptions and to decrease vacancy over time. To say I think that it's actually going to be down within the first year. It can be a little bit of a leap.
We get that all the time. We'll jump on a call with an investor that wants to dive into underwriting, and we'll mess around with the buttons on the computer, and we'll flatten out rent growth and increase vacancy just to see what it does to overall return metrics, and essentially try to break the model. You can sit in that model all day and tweak it and see how ugly and nasty you can get the deal to look. But at the end of the day, we talk about this regularly. Do you trust the operator? Have you looked into the market? What's the growth story? What's the story of the asset? Is there a repositioning strategy here? There's a lot that goes into it more than just vacancy and rent growth.
And if everything in the business plan doesn't go according to plan, if you can't achieve those premiums, what are you left with? Mm-hmm. What is that cash flow? Is it still positive? It's not going to. It doesn't have to look really great. I mean, it's rare, and it can happen that everything doesn't go the way you planned, it's still a good deal. It's rarely a good deal, but you want to, do you still lose money? How much money do you still make? Are you still cash flowing? If you're still cash flowing to a level where I'm not going to be too upset about that. I'm not going to be like bragging to my friends about it, but you know, it's a lot better than being, you know, punched in the face.
Right.
I'll take it. I mean, that's where we are when I'm like, okay, we business plan fails for one reason or the other. Cap rates expand. All these things go the wrong way, you know. And then I look at the IRR and it's a 9, it's a 10, it's a 12. I'm kind of all right with that, especially if it's a 12, because I've seen operators pitch real deals that are fully baked at, you know, 12, 13, 14. So I'm like, okay, well, our deal that's a 15 and a half, 16, if we just miss every single mark and it's a 12, I don't think that that's a horrible outcome, especially given like the long-term average of like the stock market. We're still kind of beating that average, even though the last couple of years it's been up like 20% or so.
Well, that's where the buckets come into play. You know, as an investor, you need your buckets and obviously your different return and risk profiles.
Yeah. So, you know, one piece that the report also touched on, the Yardi Matrix report, was capital markets activity, but specifically looking at some potential distress. In 2026, there is roughly $90 billion of multifamily debt that is maturing. A lot of it is CMBS, but a lot of it is agency and regional banks, private banks. You know, there's not a lot of evidence to say there's going to be widespread distress. A lot of these lenders have been working with borrowers, and it says in this report that a lot of the regulatories have been much less stringent on what the banks need to do. They're giving a lot of wiggle room, a really long leash, kind of, hey, just make it happen. We don't want a lot of distress in the banking system. You guys just kind of believe whatever you need to believe until we get to the other side of this. A lot of this distress is being worked out privately, kind of behind closed doors, and that's evidenced by a huge increase in mortgage originations. Mortgage originations rose 73%, increase in multifamily mortgage production, but, you know, transaction volumes were up, you know, according to either Yardi Matrix or Newmark, anywhere between 9 and 12%. So a lot of people are refinancing multifamily mortgages, not a lot of people buying new properties and needing those multifamily mortgages. And so there's a lot of capital that's been brought in. There's also just been a lot of preferred equity that's been put in kind of as a bridge to get it to wherever it needs to go before another capital event can take place. You know, Griffin, you asked a question, you know, earlier on, you know, just, you know, what are operators, you know, going to do?
Yeah.
You know, if you've had a deal, not just the bridge loans, you know, they were bought at the peak, but what about like the regular deals that it's time to cycle out of?
Yeah, sure.
You maybe rephrase that question the way you were saying.
I'm curious. There's operators that whether they acquired a single asset or they have funds that were acquired. Let's just say back in 2017, 2018, the equity was told up front, hey, this is going to be a 5, 7 to 10 year hold. You know, just depends on how it is. That we're nearing, you know, that disposition, you know, timeline based on projected hold period. And so there's these operators that are being not forced to sell, but their equity is looking to recycle just based off of previously expressed hold periods in what is probably not a most advantageous market to sell an asset. What are some of these operators going to do because they're unable to likely get, you know, the valuation of that asset that their equity would like to see, but also their equity is looking to recycle. So what's the optionality there? Will we see deals come out that are great deals we can essentially buy at fantastic entry points just because the runway for that fund or runway for that operator and that single asset is kind of run out?
You know, it's an interesting problem that's not just a real estate problem, you know, because we're seeing this take place in just normal, regular private equity right now, where there's the rise of these continuation vehicles, where in the past, these continuation vehicles have been more for like troubled assets that they don't want to realize losses, and they say, hey, give us a couple more years to season like the operational performance of these assets and, you know, kind of kick the can down the road. Today, it's more today those deals are suffering, but more that's happening today is there's these high quality assets that, again, whether it's a business or it's a piece of real estate, and the GPs are saying, hey, we don't want to sell this thing and break even right now. We have a ton of carried interest or promote that we're counting on getting out of this asset. We've put all this hard work on over the last 5 years, 7, 10 years. And just because in our offering document says that 2026 is the year that we need to sell, we shouldn't make a forced error and just sell it when the market is down. I mean, it's buy low, sell high. It's not buy in the middle and sell, low.
Yeah.
I mean, that's just not basically the way that you make money. And especially if you have a high conviction that we're going to be in an improved capital markets, improved environment to sell in a medium term, not 10 years, but call it 1.5 to 3 years. There's a good case to say, hey, grant us another extension, or I'll give you an option. Here's the door. You're welcome to take it.
Right.
And you'll be maybe you have to leave it a little bit of a discount. Maybe you have to leave it just at par right now. You're not going to make that much money, but if you need the liquidity, which a lot of investors are asking, hey, I need liquidity. I need to cycle this out. I have other opportunities, or I just want to give me my money back. It's been too long. Hey, if you don't believe in it, here's the door. But if you believe in it like we believe in it, come along, stay on the train, stay on the bus. We're going to take this thing another 2 or 3 years, and we're going to seek an exit at that point where maybe the IRR isn't going to be as attractive, but you're going to be able to get that multiple at the same, similar, maybe even a larger multiple. And that's where, again, IRR, it's what's the most talked about metric. We use it to compare. It's not a bad metric. I don't hate it by any means. I think it's a useful metric to compare things to. But cash flow and multiple, I think, are the absolute best metrics in terms of gauging your return. Because, your cash on cash yield just annually, how much cash am I putting into my pocket based on that amount of money I put into the deal itself. And then that multiple is, how many times have I made, how many times have I multiplied that capital? And it's many investors saying a rule every 5 years, I want to be doubling. If I'm doing better than that, I'm doing above average, below that, probably below average. And so giving ourselves a little bit more time, you should be able to, amortize more debt. You should be able to grow revenues and get to a higher multiple. And so again, as like a real estate investor, okay, so if I could sell this deal today, it wouldn't be a huge win. Maybe be a little bit of a win. But I could maybe sell it today and have a higher IRR, but then if I sold it 2 years from now, but my multiple might be significantly more in 2 years.
Yeah.
And so it's like, well, do you want a 30 IRR versus a 20 IRR? But if the difference for getting the 20 IRR is a 3x multiple versus a 2x at a 30 IRR, if that makes sense. I think if we're just talking 3 years and not another 5, I think I'll take the 20 IRR and a 3x. So I want to triple my money, so then I can go and try to double it or triple it again and get the power of compounding.
Right. That's interesting. It's a kind of a short-term solution, for those investors that otherwise don't have those liquidity needs. It was interesting. I just kind of generated this concept sitting here across from the table from you today, and I thought for certain that maybe we would see some of those assets, or maybe even just a portfolio sale, come across our acquisitions desk, or have the opportunity to buy just based on some of the liquidity needs that we've seen in the markets more recently than not. But if there is the kind of flexibility and creative solution of putting together somewhat of a shorter term hold vehicle to encapsulate that asset, encapsulate that fund, preserve its value, not kick the can down the road, but provide a little bit more patience to then see that multiple on the back end for those folks that have the optionality of being patient. It's an interesting solution to that problem.
Here's what's frustrating, Griffin, and you're not going to like to hear this. I mean, in our markets that we're targeting, going back to multifamily in the Midwest, we're probably going to see the least amount of great opportunities to buy. They're going to be very targeted. You're going to have really good relationships, like we do, but there's not going to be like huge discounts.
Yeah. No fire sales.
There's no fire sales because we have just the market's is in balance, and we have positive growth. And there's going to be fewer people who are going to capitulate and you have any reason to capitulate because there's a story there. If I do hold, if I'm a developer, like the developers we know that are kind of like underwater right now in terms of valuation, where debt is, but they're like, look, we're going to be able to grow rents over the next couple of years.
Yeah.
Okay, shift to the Sun Belt. I can't grow rents. Those are the deals where you might capitulate and say, guys, look, 3 years ain't going to fix this problem. We just have to sell now. We have to sell at a discount. We're being forced to sell. And so I think it's going to be more like regionally focused where that distress is. And it's probably going to be more down in the Sun Belt, or in the Mountain West, maybe Denver, Phoenix, rather than the Midwest. But again, you have to factor in just because you're buying at a discount and it's distress, that doesn't make it a good deal inherently. You still have to have a good performer, a good business plan that, lines up with reality.
Right. That makes a lot of sense. Buying the asset on its future value here in the Midwest, when you see all these headlines, rent growth is going to be positive, where in the nation, kind of across the board, will be negative. I can understand why there won't be those fire sale deals.
Even from a national perspective, going back to the Yardi report, and talking about delinquency and distress, it's much more lower than people think. I mean, the highest is in CMBS delinquency, and that's coming up at 7% right now as of October of this year, which is the highest rate since 2015. But, CMBS is a relatively small percentage of the overall market. The more than 50% are the agencies, and as of mid-year 2020-25, according to the Yardi report, the delinquency rate was 1.3% for commercial banks, 0.6% for Fannie, 0.5% for Freddie, and 0.5% for life companies. So that's not exactly painting a picture where there's a ton of distress. Again, not that there isn't distress, not that there aren't foreclosures, not that there aren't people losing money, and there's a lot of people who aren't making the money that they thought that they would make. But there is a lot of resilience that multifamily has shown over the last couple of years, even in these high supply markets. The capital markets have buoyed them up to kind of keep them going, because there is just long-term thesis that still makes sense. People are going to need a place to live. The population is growing in these, all across the country, but especially in the Sun Belt. And it's worth not having these assets fail. So I think it's been a pretty interesting case study the last couple of years, for running a lot of insights nationally, locally, regionally, and more. Okay, I want to move to CPI. We have to talk. We're not going to talk about it too long, because getting into the weeds, talking about CPI, I'm not a classically trained economist. I play an economist on YouTube, Griffin. I practice economics while we buy real estate here in the Midwest, multifamily. But again, we're not necessarily a tool to go into a deep discussion overall over CPI and all the math that's behind it. We can do that another time. But we have to read some of the headlines and go over some of the controversy, because there's a lot of controversy. We have this Wall Street Journal article saying, inflation eased to 2.7, report distorted by government shutdown. And people are really confused about, where we are with housing, where we are with rents, and what does, this recent CPI report mean? And if we didn't have a report in October, is it meaningless? And what does it say? What does it not say? So top line, CPI gained 2.7% in November versus a year ago. Core fell to its weakest annual gain since March 2021 at 2.6%. Housing CPI maintained its tamer pre-shutdown pace at positive 0.2%, which averaged over September to the November period, which lies the controversy. Energy CPI inflation really accelerated up to 4.1%, and then services less shelter inflation saw an average 0.2% gain from September to November. So the controversy, the rub. Everyone is saying, look, we had this government shutdown. We don't have any data from October. You're taking September's data, and now you're taking November's data. And you're just assuming the rents were low in October. You can't just assume that. That means the data is all wrong, and maybe we have higher inflation than we actually did. There was consensus for around 3.1% of year-over-year inflation from a lot of economists. And so everyone has kind of had their feathers ruffled because 2.7 didn't align with their projections. Here at the Gray Report, we even anticipating CPI to come in really for the last year and a half. What's been frustrating is all related to owner's equivalent of rent, which is how CPI computes housing costs. And it's basically their method to take housing and translate it into a service. And it is not real-time market rate rent data. It's trying to understand just kind of the cost of housing for new leases, current leases, and just overall generally what people are paying. Here's the problem. Rents have been flat or negative for the last several years, but rents, according to CPI, have been growing by 3 to 4% for the last several years. And the idea is that the CPI, OER, and shelter index is supposed to be lagging between, call it 9 and 15 months, call it a year. Different people have different time ranges. It really doesn't seem to catch up. And so people are wondering then, okay, well, we don't have October's data. We don't know what rents, the direction of travel in October, but we know exactly the direction of travel in October. October was one of the weakest months for rent growth in years. It was slow. It was no different than the September print. If anything, it was lower than what we had anticipated from the September print. And then going into November, it paints a similar story. So it's low rent growth. And so this quote, there's a quote here from UBS, Alan Detmeister. Quote, "I think you largely just put this one to the side. Maybe this report gives minor downward sign for overall inflation, but the vast majority of this is just noise and should be ignored." We were looking for any kind of data, any signal over the last month during the government shutdown. They actually put out a report, and now it's just noise. It needs to be ignored, which I was telling you, as soon as folks from UBS start saying, don't look at this report, don't look at this, look over there, that just makes me want to look at it even more.
Right.
This is making me even more confident in just given what we're seeing at rent levels, the fact we have 500,000 units still in lease up, we're going to see slower rent. And that rent is not going to turn around on a dime. We see all this new supply that's still coming online. Rent and OER on CPI has acted as a buoy over the last couple of years. Lagging, it's keeping everything high. It's dragging inflation up, at least the CPI print. If we look back into March when actually CPI bottomed out to almost 2.2%, if we had adjusted for real-time market rents, and CPI would be below 2%. It would be below the Fed's target.
Yeah.
And so with no evidence and no ability for rents to really increase, whether it's market rates or in the CPI, we're going to see lower CPI prints or that trajectory lower over the subsequent months and over the next year and a half, up to 2 years. Again, shelter makes up over a third of CPI, and it's going to be this anchor. Even if you have services spike up, shelter is going to be bringing it all down. What this means is, at least for the Federal Reserve, in shorter-term interest rates is, I'm not saying we're going to see a lot of rate cuts next year, but interest rates are going to be at least slowly moving lower over the next several years, not higher.
I'd like you to pull up the Jay Parsons LinkedIn. If you could do that, I'm going to give you a little bit of time. And I'm sitting here kind of smirking as you're discussing the presumable direction upon which inflation can go. I've got a neighbor across the street. He's a little bit older, and he has come over a few times to help me, a new homeowner in the yard.
Yeah.
I've got a few trees that I need to remove, and they tend to lean one way. And he'll look at it and he'll say, well, there's only one way that thing can go.
Yeah.
And you sound like my neighbor when he's looking at my trees, because there's no way that thing's falling the other way.
Yeah, gravity.
Right? With all of the data that we have in regards to housing, the direction upon which we know rents will continue to go really throughout probably the first half, if not the entire year of 2026, how can inflation go anything, maybe but down or up? And there's other factors involved, but with the visibility into the housing data that we do have and the rent data that we do have, it seems like you're looking at inflation kind of like my neighbor looks at my trees, saying there's only one way that it can go.
I mean, that's the preponderance of the evidence, at least right now.
Right.
And again, evidence could pop up that changes the narrative. If we really start accelerating, we had a strong GDP print that came out. I think we've got 3.4% GDP growth for Q3, which is really strong GDP growth, well above estimate, above trend. With lower immigration that increased wage pressure, wages increase, that all leads to inflation. I think there's this idea that we've had pressure from tariffs, but that's a relatively kind of a transitory event that we see price increases once. The caveat there is not everybody increased their prices at once, and that they've been kind of tapered in over time as producers and importers have been slow to pass some of those costs on to the end consumers. I mean, we're waiting for a Supreme Court decision whether those IEEPA tariffs are going to stay on or are they going to go off. It may cause some disruption, but generally things are going to stay relatively the same. So, there's an argument that we could see some more inflationary pressures. Reshoring, making more stuff in the United States is probably going to be a little bit more expensive than having a fully globalized supply chain. But I don't think we're going to have a balanced approach. I think we're going to have secure supply chains. If we're going to make some stuff here while also importing elsewhere, because I think the free market is way too strong and powerful. Because if Vietnam is making something for a fraction of what we can make it here, we're probably going to import it from Vietnam, even if we pay a tariff. Right. So we do have some reasons that inflation could kick up, but then we also have AI, which is in technology, which is a great deflationary pressure. Increased productivity, we can make more with less. That means we can have, we can produce goods cheaper. People, their dollar theoretically can stretch further to buy more things. Maybe not all things, maybe not housing, but look at technology with what you can do with a phone or computer compared to decades ago. It's pretty incredible. Just look at what you can get accomplished with Gemini, ChatGPT, or et cetera. It's pretty amazing. How that exactly translates into gains, some is yet to be seen, but I think most people would acknowledge that there are some real gains. Obviously, we bring in the employment picture, and does that increase unemployment because firms aren't hiring as much? Right now, we're not seeing a lot of, and we're seeing some firing, we're seeing some layoffs, but it's not widespread. We're also seeing less new government jobs, and so instead of adding 140,000 on average new jobs, a lot of those were public sector jobs, government jobs. Now we're seeing a lot of folks come off the government payroll and adding less to the government payroll. And so it's just less robust job growth, but maybe it's a little bit more like real economy job growth, which may be a little bit more imbalanced. We also have demographic shifts of, maybe we lose all these jobs, but we're also missing a lot of people. Gen Z and Gen Alpha are much smaller generations compared to millennials and the baby boomers. And so we're kind of like, if we don't have immigration coming in to fill those gaps, we're going to need robots or somebody to do the work.
And they're coming. And
I think you have to have you either have to be an optimist or an absolute pessimist.
Right.
And not that there can't be some volatility and muddiness in the middle, but I think it's either going to, full-on Arc Raiders post-apocalyptic scenario with AI, or things are going to be pretty good.
Utopian versus dystopian at some point.
Yeah.
We were talking about
scarcity,
CPI,
maybe.
And I had you pull up this Jay Parsons post. I think it's a great summary for those of us
somehow we got to post-apocalyptic.
Yes, we did. I think it's a great summary for those that otherwise maybe don't have time to dive into all of the details that can impact CPI. But I think the most important thing for what we're talking about here today on the Gray Report podcast is that last paragraph, and it could involve a few of the texts above, but it essentially just says any real pickup in CPI or rent and shelter is unlikely to show up until 2027 at the very earliest, more likely in 2028. Maybe, there it is. Just based off this 12-month lag, you said maybe 9 to 15-month lag. We've had negative rent growth across the nation for the entirety of 2025. So that means in 2026, obviously, that data will begin to show up in CPI. What are your thoughts, I guess, on this Jay Parsons post in regards to, kind of the overall picture and theme, as well as that paragraph you have highlighted there?
Yeah, I think he's keeping everybody honest and just level setting of saying, hey, guys, let's all just settle down. It's really clear of why we're seeing rent deceleration and that we're going to continue to see it. And that rent deceleration is going to be and anchor keeping CPI low over the next at least a year. And again, so let's say it's 12 months on the dot. We've got negative rent growth today. Well, that's at least 12 months. All of our forecasts are showing that the first half of 2026 is going to be pretty damn weak.
Yeah.
So that's at least an 18-month period before we see any kind of acceleration or really true growth, or positive growth in the shelter component of CPI if there is that 12-month lag. And again, it's 12 plus months. We were tracking this every single week. We're waiting for rents of CPI to start coming down because the market rents had been coming down, and at 12 months we've said, okay, now they should start to be coming down. It's a 12-month lag. Well, CPI rents kept increasing, right? And not just, obviously they're increasing month over month, but it's the rate of growth was increasing. When it's like, no, the rate of growth should be decreasing substantially. And in fact, rents are negative. And so when is this going to show up? It took well over 12 months, closer to 18 months. So we're going to have a long period of where just CPI, there's just not going to be the argument to say that inflation is really high. Even inflation may be high in some areas. We could have energy inflation. We go to war with Venezuela or something.
Yeah, sure.
But, and that will certainly impact things, but shelter should keep things relatively lower. And market participants, investors, economists even have relatively short-term memories, and we're going to kind of forget about all of this for a while, and we're just going to know that, well, CPI is saying that inflation is, closer to 2% than 3%.
Yeah, I think this last paragraph too here is what he's saying exactly what you just said when I was talking to you about my neighbor with the trees, upon which there are other ways it could go, and there's other factors that come into it, but it's simply kind of outside of, obviously, his wheelhouse and also ours. But
tornado comes through, whips that thing the other direction.
Right.
Black
It
swan.
Could be other things. This is also a kind of a visually stunning graph from what I think is some pretty long-standing data. You kind of look how flat inflation was from, 2013 to 2020, and then we saw a dip in 2021, 2022, and then it just kind of took off.
Yeah. And again, we still have room to go because the rent growth has been lower than pre-pandemic average for a little while now. And so it's not like we're going to flatten out here where we were, and that's going to be the anchor. We're going to get down to, I don't see any evidence where it goes negative. We'd have to have like deep negative rent growth for a long period of time, just from my understanding of how OER is calculated, but getting down to that kind of 2% range is very reasonable, and maybe a little bit lower than 2% on CPI for shelter.
It's interesting just to see this visual and the pre-pandemic average versus where we stand today. Like you said, the data for 2025 should show up in 2026. There could be a long way to go down. It would be interesting to see how low it does go.
Yeah.
Or could go.
Again,
a lot of things got to go right.
As we were saying that, I was like, well, 2% of, it can get at least down to 2%.
Yeah. The Fed's arbitrary target.
Yeah. And, and let's see if they reassess that. I think that they kind of want to, but, listening to Scott Bessent, recently in an interview that he did, they, even though that argument can be made, and I think a lot of people want to make that argument that maybe the long-term inflation target should maybe not just be 2%, maybe is it 2? Is it 3? The conversation was it being 3 long before all this happened. I mean, 10 years ago we were talking about the target. Should the target be 3? Because there was no inflation, and so maybe we need to stimulate a little bit more to try to get a little bit of inflation to maybe average out, at 2%. Sure. And so, but now the argument against shifting that is, are we moving the goalpost that every time we find ourselves out of target, do we just change our goals when we're out of target? But when you've come back and meet your goals and you're on target, then that gives you the ammunition to go out to the public and say, now we're going to readjust our goals because we think this is the right decision, even though we have the ability and have shown that we can get inflation down to whichever target we choose.
I think the individual from UBS, that essentially was asking us to look the other way, or maybe not give as much merit to that report as other previous reports. As interesting as I was combing through all of the articles for the newsletter over the last 2 months, really in the midst of the government shutdown, there was so much begging and pleading for transparency into, core data, and we finally got some. And here is, no, it's just one individual.
Don't look at
but
it.
here's just one individual that says, hey, this is just noise. I think, like you said, and if we pull up their chart, the refusal to connect the dots from, what would be September to November, I think is kind of laughable. It's like we all understand kind of what went through or what was going on during that period. But the refusal to connect those dots, I think, is a little foolish, just because to get to where we are in November, there's no way we see a spike up, so abruptly in October. I don't see that happening. Maybe if you look at January, there was kind of an uptick to go back down in February. But it seems like we could not arbitrarily, but we could draw a line in between September and November with a little bit of confidence.
Yeah, it's a good point. I was thinking about that too. Yeah, like if you look between December and February, in 23 or 24 to 25, there was a little tick up before it ticked down. But again, that's where we come back into, it's not like we don't know what happened in October. And, and it's fine. We're not going to connect the dots because there is no October dot. So we'd have to make a long line down.
Mm-hmm.
But, you're making lines during period, you're making a line 1 month to the next. I don't see why skipping a month means you can't make a line.
It's just going to make this chart in question for the next 12 to 15 months.
Yeah.
Because now everybody's going to say, well, what about that gap?
But that's where I just encourage everyone and to get out of your head that, we have to, that CPI and the BLS are the givers of truth.
Yeah, the end all be all, for sure.
The end all be all. When it's like they're using this methodology that may have like a decent calculus and for certain periods and certain environments, and there's thought behind it. But to say, well, we don't know and we can't make decisions because we don't have the data because the one data source wasn't available, I think is really, I think it's kind of immature and doesn't look at the totality of the information and is really a, 20th century mindset. Mm-hmm. And it's so backwards. We have so much information that's available to us.
We do.
I mean, this is the age of, I can go on ChatGPT and have it do a full analysis on the state of the U.S. economy, and it's going to be able to produce a research report that's pretty damn accurate, just as good as some of the top consulting firms.
Right, in a matter of minutes.
Together. Yeah, in a matter of minutes. And so again, to say that it's like we need to ignore CPI while I'm discrediting CPI, like we can make some assumptions on our own, and we know what happened in October. The rents were lower.
Mm-hmm.
So,
yes.
Well, this has been an exciting episode. If you find this stuff interesting, multifamily housing, commercial real estate,
golf,
this is the place to be. The Gray Reports. Make sure you like this video if you found it halfway interesting. The fact that you're still listening, you've been called out. You have found this interesting, or you do not know how to turn YouTube off, which we've all been there. But even so, you're getting the message. You might as well subscribe to the Gray Capital YouTube channel. And if you'd like to learn more about Gray Capital, hop on over to our website, graycapitalllc.com. We try to find really interesting multifamily deals in the Midwest. We're owner-operators. We manage our own properties. We do as much in-house as we can. We really like doing good deals, which means we haven't been doing too many deals lately. So you got to get on the list, because when we do find one, the way we're talking about it is it's going to go quick, because we have a lot of big investors. And this is different from our previous deals, where the vast majority of our capital was raised from like individuals and family offices, always talking to some institutions, but they're like, we want to be able to control your deal and do all this stuff. And we're like, we've got all these people that want to invest with us. We don't necessarily need you. We've got a couple groups that are making some pretty attractive offers, and so they may take up like 80% of the capital on a deal. And so we're going to have less money to raise from our normal retail investors. We'd like to have many deals, so everyone still gets in. But this is, we may be approaching a period of time of where when we say, hey, Gray Capital, we've got a deal, hop on, subscribe. It's not well, let me know when you're almost raised. Let me know in a month. It's going to go within a week or less.
The deals are scarce. The capital equity availability in our projects may be even more scarce.
What I'm looking forward to, because of that, exactly what you said, we can we can kind of handpick all of our favorite investors.
Right. Play favorites.
Play favorites.
I'm excited about the next project that we have in-house. Like Spencer said, we've got some significant programmatic check writers that are looking to take up a sizable portion of our equity. With that being said, our existing investor network will likely have first come, first served rights.
100%.
But we also really value the opportunity to create new partnerships and new relationships. So if you're interested in partnering with Gray Capital on a future project, preferably our next one, we'd love to have that discussion just to get your name in the hat.
What you don't want to do is, you've been subscribed to our YouTube channel for a while. You've been listening to the Gray Report podcast. You've been thinking about investing with Gray Capital. You're an accredited investor, which that's key.
That's key.
Thanks, SEC. Then you're like, I want to talk to these guys about it. But then, no one likes to commit to an investment. You're investing $100,000 on the first call. You're going to want to think about it. Griffin, he's going to try to close you because he's good at what he does. But it's reasonable for you to say, hey, let me take this back. Let me consult all my advisors, my consultants, my team, my attorneys, all of the people in your corner. And it's going to take some time. What I'd recommend you doing is having the call now, sooner rather than later, before we have a deal. Let us get to know each other, get to know Gray Capital, have a conversation with Griffin, Blake, myself. We understand what your goals and objectives are. You make sure that Gray Capital is the right fit. We make sure that we're a good fit for each other. Once you kind of checked that box, you kind of know how we structure our deals, what they look like, what our last deals were. Then when we do have an opportunity, we know that you're ready to go. We know who you are, that you're a known quantity, and you're going to get pushed up on the list. And at that point, you don't have to do the whole getting to know you. It's tell me about the deal. Let's break it down. I've gotten all the materials. You'll be ready to make a decision before everyone else is committed. So don't wait until we have a deal. Schedule a meeting with Griffin. Get access to our investment portal at graycapitalllc.com. You can start going through, filling out all of your information. You can be ready to go. And then when we do have a great opportunity, early in 2026, you are primed and ready. You're not going to miss out on the opportunity. We're looking forward to an exciting year. I'm not saying there's going to be a lot of deals, but we will have a few deals, at least one or two. And I am just bullish on the vintage of 2025 and 2026 real estate deals. There will be some great opportunities that in 2030, 2035, we're going to be looking back and saying, those were the good old days. Just like over the last couple of years, it's like I wish I could go back to 2009, 2010, 2011 to buy all the real estate that I could. We're going to be saying the same thing. The real estate has been kind of out of favor for the last couple of years. We saw the fear and greed index. Well, I believe like many things in the universe, there's cycles, and business cycles are no different. Real estate cycles are no different. I think people are still going to need a place to live over the next 10 to 15 years. And I think capital markets are smart enough to understand where to allocate resources. So hop on the train with us. It's a great opportunity to invest with some experienced operators that put their own money into their deals. We're vertically integrated. We try to do the right things and occasionally have a little bit of fun while we're doing it. Griffin, Happy New Year.
Happy New Year. That's a wrap on 2025.
Let's do it. Thanks.